Good morning and welcome to the Smart Financial Planning 9th of November review of the weekend papers. A couple of things have caught my attention this weekend. Firstly, Gordon Brown's slightly strange suggestion of introducing a Tobin tax on foreign exchange transactions. This idea has been around for nearly 40 years now, and at no point has anybody ever thought it was a good enough idea to implement. In fact, Lord Adair Turner, the head of the Financial Services Authority, suggested this as an idea 6 months ago and was roundly poo-pooed by the government and most international governments as well. So particularly strange now that 6 months later Gordon Brown decides to go to the G20 summit and propose exactly this same tax. Surprise, surprise, the minute he's finished speaking, the US and the Canadians make it very clear that they wouldn't support it, and in Gordon Brown's speech, he made it clear that he would only support it if everybody else supported it. So all in all, seems a bit bizarre. The only conclusion I can come to is that the purpose of this tax was to raise funds to generate a slush fund to bail out banks in the future. And the only conclusion that I have is that Gordon Brown wants to get the subject on the agenda so that there will be some tax in the future put in place to create this pot of money, even if the Tobin tax, which is a tax on foreign exchange transactions, doesn't become the one that actually people are interested in having. But all in all, slightly strange. Carrying on that theme of slightly strange, over this weekend it's been announced that PricewaterhouseCoopers believe that credit companies are going to start charging fees for the provision of credit cards and are going to increase the rate that credit card holders have to pay. At the same time, as Northern Rock announced that for the 4th time in a month they've cut their interest rates, they're now offering market-leading interest rates on their mortgages and are very definitely looking at trying to move the mortgage market forward. Not only are they offering more competitive rates, they're actually reducing the loan-to-value requirements in order that people can get those rates. For the last number of months, 60-65% is the maximum that would be lent at the very best market rates. Northern Rock's talking about pushing this up to 75%, 80%, possibly even 85% loan to value. That's much more similar to the sort of situation that we had in place prior to the credit crunch biting in the first place. So I think this is actually very good news. I don't really understand what the credit card thing's about, although the suggestion is it's to do with some bad debts they have on their books, but much more importantly, the fact that the mortgage rates are starting to come down, and much more importantly than that still, is the fact that they're going to be offered at a higher loan to value rate than they've been offered in the future. If that starts to happen, and if it creates transaction in the whole market, then what we'll find is that the mortgage market starts to move, therefore the property market starts to move, and we can genuinely start to see then it looks like there might be light at the end of the tunnel. The final thing I wanted to share with you this week is that you may notice that we've had a bit of an overhaul of our website. What we've been trying to do is make it easier for people to come into the website, see the variety of information that we've got available to them, and go directly to it. If you think it's good, we'd love to hear from you. If you think it's bad, equally, we'd love to hear from you. Any feedback that you've got on it would be great. I look forward to seeing you again next week.